All right, so let's talk about credit. What is credit all about, and how can I build good credit? This is a very important area, so I need you to pay very close attention. First, let's talk about why you need to know about credit. You're going to need credit in order to qualify for loans to buy a car, get an education loan, start a business, or to buy a home. These days, insurance companies also look at your credit rating as well to figure out how much you're going to be paying for the insurance. And finally, a lot of jobs that you may apply for, more and more jobs are looking at credit rating as well to see what kind of person they're going to be getting. So making sure that you have a strong credit rating is very important for a lot of reasons. Okay? Before we move on, let's just talk a little bit about what is credit. Credit is basically where you get the money for the thing that you need now. Let's say it's a car or a home. And you get to use that thing, and then you agree or you make a promise to pay that money back by a later date. When you use credit to get the thing that you need, you end up paying more than the original cost of that thing because of something called interest. Okay? Interest is basically the cost for that money, and I'm going to give you a couple examples in a minute or two of how that actually works. The amount of interest you pay depends on your credit history. How good have you been in paying your bills? How good have you been in keeping your promises? And we're going to talk a little more about that soon. Your interest rate is the percentage of the original debt that you're charged on top of the original amount. I know it's a lot of words. Let's give you an example. Let's talk about credit cards, for instance. Credit cards are similar to loans. They're a type of a loan. Credit card company lends you money and charges you fees or interest in order for you to be able to use that money. So let's say we're talking about $1,000, for example. Okay? So the credit card company says, okay, you can use $1,000. Okay? You have an interest rate of 25%. Okay? Now, what that means is if you take 1 year to pay that money back, you're going to end up paying $1,250 in total. You're going to pay the $1,000 plus the 25% of that, which is $250. Okay? So these two together equal $1,250. And that's how much it's going to cost you in order to take 1 year, let's say, to pay that money back. So this is the interest. And this interest, how high this interest is going to be, depends on your credit rating. So having a higher credit rating is going to save you a lot of money on interest. And I'm going to show you a couple ways that actually works in just a minute. Now, credit cards aren't all that bad, obviously. They make things very convenient. Many businesses accept credit cards, so they're not all bad. You just have to be responsible and be educated and make sure you're paying attention with all your spending that you use credit cards for. Credit cards make things like buying clothes and groceries a lot easier. So making sure that you pay those bills off in full every month instead of paying interest for your pastrami sandwich, that's going to end up saving you a lot of money. So what does that take? That takes proper planning and budgeting, which we talked about in a previous lesson, and that's going to save you a lot of money on your interest. Okay? So just know that up front, credit cards can either be a very useful tool if you're responsible, but if you're not careful, they could become a huge trap for you. So avoid racking up credit card debt. It's a very miserable place to be. You don't want to be there. So be responsible and take care of things early on. Don't let it pile up. Okay? Now when you're starting out, just so you know, you're probably going to have higher interest rates and lower spending limits until you finally prove to the credit card companies that you're responsible. So be prepared for that. The sooner that you could show them that you're responsible, they're going to raise your limits and they're going to lower your costs. But you have to earn that. Now, as I mentioned in a previous lesson, one way to establish credit is by using something called a debit card. And that's going to help you to manage or practice how to deal with a credit card later on. A debit card is basically plastic money, okay? and it's where everyone qualifies for these things for debit cards. You will not have to prove income, give your social security number or anything like that. They're accepted everywhere, and it's basically where you just load the debit card with cash, let's say $200 or $300 up front, and you just spend against that money that you put on there. And this gives you some practice so that you can avoid late fees and over the spending limits that credit cards have. You basically lower your expenses by not dealing with credit cards up front. By practicing with debit cards, you give yourself a good way to learn about how it all works. Okay, now as far as when to get credit cards, I wouldn't recommend getting a credit card until you're able to live within your means and you have at least 6 months of expenses put away in your emergency fund. Do not get credit cards before that time. Okay, until then, try to use only debit card. Okay, a couple of other ways you could build credit is by getting added to your parents' utility bill, the electric bill. That's one way to do that. Or the phone bill, let's say. Make sure it gets paid off in full every month. And of course, if you use the lights or the phone at your parents' place, I'm sure it's going to make you feel a lot better to chip in. And I'm very sure that it's going to make your parents feel better if you chip in too. All right. Now that we've talked about what credit is and how that works, let's talk a little bit about your credit history. Think to yourself, just ask yourself a quick question right now. Why would it help you to have good grades in your classes at school, in junior high and high school? Why do colleges care about your grades, and how is it going to help you? So write down a couple of reasons where you are writing down basically why is it a good idea to have good grades in school. Got it? Okay. Guess what? Having good credit is very similar to having good grades. It can make your life a whole lot easier to have good credit, but having bad credit, that's going to make your life way more difficult. All that good credit really means, though, is how good have you been in paying your bills on time and keeping your promises to pay for stuff like a car or anything else. Just like you have a report card at school that shows all of your grades, there's also something called a credit report, and that shows your credit history and how good have you been about keeping your promises to pay for stuff. A credit report is going to list the promises you've made to pay and how have you been in doing so. It's a detailed account of how much do you owe, how have you been paying your bills, and have you been late, okay? Now all of your credit behavior is going to receive something called a credit score. Your credit score can be anywhere from 300 is pretty low, all the way up to 850 and everything in between. So your score is 850, this is the high end, and the low end is 300, okay? So it's a little bit different than your grades at school where you get an A or a B, but you're still being judged, and the higher your score, the better your credit rating, okay? Now the benefits of a good credit history or a credit rating is that you're going to be approved to rent apartments, get the better job. As I said, jobs do look at your credit history. You're going to get approved for loans like for a car or a house or a business, and you're going to get lower interest rates than people with bad credit get. But people with bad credit end up paying a whole lot more for stuff, okay? So by having good credit, it saves you a lot of money, which you can invest instead of paying it in interest, okay? It's going to save you thousands and thousands and thousands of dollars to have good credit. Now, the best part of all of that is that having good credit is one of the easiest things you could do. You just got to pay attention, be responsible, but it's definitely not rocket science to build a good credit rating, especially if you're starting early and you know the rules of the game up front, okay? Now, let's talk a little bit about credit bureaus. Credit bureaus are the folks that basically collect all of your credit history information. There are 3 of them. They're called Equifax, Experian, and TransUnion, okay? And these people are the ones that give you a score or a grade. They are separate from each other, and each keeps its own records. Sometimes what one reports about you may be slightly different than another, but for the most part, they do report pretty much the same stuff for you. They look about 7 years to 10 years, back. They look roughly the last 10 years is what they're typically looking at, okay? Now the grading system that they use, the scoring system that they use is called a FICO score. And that's what this is right here. This is a FICO score. This is a FICO score, and everything in between here is a FICO score. Now a 720, this is basically like having an A or better, okay? If you have a 660, that's kind of like having a B or better, okay? If you have a 620, that's basically like having a C or a better. If you have anything below a 600, I would spend some time trying to get that repaired. You need to be in this area or better in order to get approved for loans, at least as far as credit is concerned. There's also income, proving your income, and other things like that, which we'll get into when we talk a little more about credit. But as far as your credit score goes, this is the system that they use. FICO is the Fair Isaac Corporation, just so you know, Fair Isaac scoring model. That's what that stands for. Now there are 5 areas that the FICO score looks at to come up with your score. So let's talk a little bit about that and how do they even determine your FICO score? How can they say that I have a 720? How can they say I have a 628? Where is that all coming from? Okay, so the FICO score. All right, the number one thing is your payment history, okay? This is very, very important. There's a reason I made that the number one thing is how have you been in making your payments? Have you been late? Have you been on time? How have you been? The number 2 thing is how much do you owe? If you owe a lot of money, then that's going to bring your score down. Okay, so that's also very major. Now, another thing, number 3 that they look at in coming up with your FICO score is how long of a credit history do you have? The longer the better, but don't worry, as you build, you're gonna build your credit history over time. But one thing that they look at is how long have you had your credit? Okay. Somebody who's just starting out, few years, 3 years old, is not going to have as good of a credit rating as somebody who's been using their credit for, let's say, 20 or 30 years. So that's something to keep in mind, but again, you're going to build it over time. Number 4 is new credit. How much new credit do you have? Did you just get a car? Did you just open up a credit card? New credit does have an effect on your credit rating, so keep that in mind. If it's recent, sometimes it's a little bit negative, but that's temporary. As long as you're responsible with paying for it, it can actually help your credit rating to go up. And number 5 is the types of credit that you use. Now this is very important to know. Car loans and home loans are looked at as more safe or more secure than credit cards. That's because if you stop paying on your car, there is a car backing it up. The bank can come and take your car back if you stop making your payments on a car. But with credit cards, if you have a lot of credit card debt on your credit report, they cannot come back and take away the toys and ice cream that you bought with your credit cards. So that's one major difference between these 2 types of credit is auto loan or home loan or credit cards. Credit cards, if you have a lot of debt on your credit cards, it's looked at badly, and you want to try to avoid that as much as possible by paying off your debts. Now let's talk a little bit about how to keep good credit and what's within your control to do exactly that. So let's talk about how to keep good credit. The number 1 thing you can do, of course, is pay your bills on time. So keeping a good credit rating, okay? Number one is pay your bills on time. This is very important. Probably the most important thing you can do. Now, setting up automatic bill pay through your bank, that makes all that very quick and very easy. The number two thing you can do is don't borrow too much money, because that will make a huge difference in what kind of an experience you have when it comes to credit, okay? Keep your debt low. Number three is not a lot of inquiries. Okay, what is an inquiry? An inquiry is when one person or one company, let's say, asks about you, makes an inquiry, asks questions about you. Now, that's basically when a company checks your credit or runs your credit, or a credit inquiry. If this happens a lot, then it's going to lower your score a little bit, but it is temporary. It tends to come right back after a while. But if you keep checking your credit or having people check your credit because you're looking to get a car loan, if you have a lot of credit inquiries on there, it's going to drag down your credit. So be careful about that, okay? Another thing you do to protect your credit is carry enough auto and health insurance. Okay, carry auto and health insurance. Now, the reason I say that is because medical bills are a major cause of bankruptcies, which destroys your credit. Protecting yourself with the right amount of insurance coverage is going to help you avoid these huge medical bills that come from health insurance, and even sometimes auto insurance, not having auto insurance. Let's say if you have to pay for someone else's medical bills, that can destroy your credit. Another thing you could do definitely is checking and monitoring your own credit periodically, okay? This should happen at least once a year, one time per year, but it wouldn't be a bad idea to do it 2 times a year. More than 2 times a year, that's getting excessive. I wouldn't recommend doing that, but keeping an eye on your credit is definitely a good thing to do, okay? Now, having credit cards open that have 0 balances, that also has a positive effect on your credit rating. So credit cards with 0 balances. As long as you could prove to the credit bureaus that you can get your hands on money if you needed to, then that actually builds your credit rating, okay? Another thing you could do is use your credit, but make sure you pay it off every month, okay? Sometimes not using any of your credit at all can actually have a bad effect on your credit rating. So I'm not recommending to not use it at all. Use it, build it, and be responsible about it. The final note I have that is, at all times, no matter what, control your spending. Do not take on more debt than you can ever afford, whether it's credit card debt, car loan debt, or any other type of debt. It becomes very dangerous, and it becomes a miserable place to be. Now, the key is that without an excellent credit rating, you're going to be viewed as a higher risk to lenders. They're going to charge you more if you're a higher risk, and it's like you're giving your money away. Let's take a little example. Let's take a ride to the car dealership, okay? Because we want to get a new car, we want to borrow some money in order to get a $25,000 car. Okay, sounds like it would be a very nice car. Go ahead and pick what color you like and all of that. So we have a $25,000 car. And I'm going to go ahead and draw a picture of a little car here. I'm not an excellent drawer, you could see, but here's our car, okay? Now, someone with good credit is going to be asked, can I get you coffee? Can I get you water? Can I massage your feet? You're going to be treated a whole lot differently as someone with good credit than with bad credit. But let's talk financially what that really means. Somebody with good credit is going to get a 6.25% rate, which is not so bad for an auto loan. And that, okay, so let's take an example of how this actually works in real life, okay? So let's say we're buying a $25,000 car. So $25,000 car, must be quite a nice car. I'm not an excellent drawer, but let's say we have the car right here, boom, wheels on that. This is our $25,000 car. Now, someone with good credit is going to receive a lower interest rate than someone with bad credit. But let's take a look at some examples. Someone with good credit is, let's say, going to get a 6.25% interest rate on their loan, okay? Someone with bad credit is, let's say, going to get a 12%. So what does this actually mean? The person with good credit is going to pay $486 a month for their car loan, okay? The person with bad credit for the same car, exact same car, same color, same package, same wheels, same everything, is going to end up paying $556 a month. So what's the difference? The difference is $70 a month more that this person is going to be paying over this. What that means is $800 more a year that this person is going to be paying or throwing out the window. And what does that mean in the course of over 5 years? That means this person is going to spend $4,000 more, over $4,000 more than the person with good credit. This person is going to be able to invest this money instead, save that money instead, and enjoy it in a whole lot of other ways, but this person is stuck having to pay it into their interest. So that should give you an example of how much better you get treated when you have good credit. Now let's talk about a very important area called identity theft. This is when thieves get a hold of your social security number or your account information of your checking or savings accounts at your banks, and they basically make charges on your credit cards and steal money from your bank accounts without you knowing, okay? You can protect yourself against this kind of stuff by taking a few steps. The first thing we want to do, let's go ahead and erase this example about the $25,000 car, and let's get into identity theft. Okay, so what are a few things you can do to protect yourself against identity theft and people basically stealing your identity and stealing your money? Okay, number one, purchase a shredder. This is a little machine you slip pieces of paper into and it shreds it up into little confetti paper. Do this with your credit cards statements and your bank statements every month as a habit to protect yourself from getting your information getting in the wrong hands. There are folks that go into dumpsters and garbage bins of people that they know have a lot of money and a lot of credit, and they will take your information, steal it, and it will be a miserable time for you. Okay? Another thing you can do is do not share. Don't share your information. That means PIN numbers with your debit cards, any personal information. Do not share your information. Keep it hidden and safe away from the wrong hands. And of course, something we've already talked about, monitor your credit report periodically, at least once a year. When you're looking at your credit report, which you should do anyway, also look for accounts that you don't even know what they're about. Why are they there? Is somebody messing with my credit? Always ask yourself that question. Always keep an eye out for that, especially in this age when there's so much technology out there. If you keep your information on your cell phone, like private information, bank account info and all that, PIN numbers on your cell phone, make sure that you lock your cell phone every time you're done using it so that if the wrong person picks it up at the coffee shop or wherever it might be, that you are protected and the wrong people don't get to see your info, okay? Now, if you become an identity theft victim, there are a couple of things you can actually do, okay? Let's talk about that. So, if you're a victim of ID theft, what do? The number one thing you should do is contact the credit bureaus. I mentioned the 3 names earlier: Experian, Equifax, and TransUnion. You could look these folks up online. I will have some information about them on the website as well of how to get in touch with them, and let them and put in a fraud alert, something called a fraud alert. And that basically lets them know that you are taking steps to prevent the wrong people from having your information. Okay? So a fraud alert with the bureaus, the credit bureaus. Contact the credit bureaus. The number two thing that you can do is you can go ahead and close the accounts that have been opened without your permission. So go ahead and contact those companies, the credit card companies, whatever it might be. Let them know what's going on. They should be able to comply with you to close out those accounts that are being used without your permission. Another thing you could do is contact the FTC. That's the Federal Trade Commission. This is a government agency, and what they do is they protect customers and regular people like you and I against thieves and people who do this kind of stuff. So definitely file a report, file a complaint with the Federal Trade Commission. And finally, the last thing you could do is file a police report, and hopefully the police can help you to connect with the people who are taking your information and bring a stop to it. Okay? So those are a few steps you can take when it comes to identity theft. Now let's get to the final part of this segment. Is because you know this, you're going to avoid getting into trouble and having to pay for more stuff than you should and pay more for things than you should. You're going to get better treatment from lenders for loans for cars, homes, businesses, education, and all the other reasons you're going to need credit. And you're going to end up saving a whole lot of money over your lifetime by managing your credit rating responsibly. You're going to have more money for things that you enjoy, and you're going to be able to save for a rainy day and invest for your future instead of overpaying for loans because you have bad credit. Good credit ends up saving you a whole lot of money over your lifetime, and knowing that is the key.